What's up everyone, it's Caddy with Money Investing. So in this video, we are going to be going over Bullard speaking right now, and we'll just listen in on that, and then we'll jump over to the charts and the markets and go over the yields and whatnot. So hope you are doing great. Just let me know in the comment section if the audio and the video is working well. We should be all set. We got the QQQ slightly down about 37 basis points. We got the SPY slightly down about 26 basis points. And we've got the Dow Jones slightly pulling back a little bit over 14 basis points as well. Let me know in the live chat if you guys can hear this.
These are numbers that Alan Greenspan never saw. They haven't occurred in 40 years. So our credibility is on the line here. And we do have to react to data. However, I think we can do it in a way that's organized and not disruptive to markets. We're only removing accommodation, so it's still an accommodative policy as we go through these initial rate hikes. They're rather cheap, actually, given that unemployment's down at 4% and the economy is expected to grow, let's say, 3.5% to 4% this year. So I think my position is a good one, and I'll try to convince my colleagues that it's a good one.
Some said the January inflation report was really not much worse than expected. Actually, just a couple tenths higher.
No, let me push back. I'm pushing back on that. This is, I said, let's take the four reports together. Let's take the four reports together since October, because it's really October, November, December, January that has really called into question any idea that this inflation was naturally going to moderate in any reasonable time frame without the Fed taking at least some action. So it's that, I think, sure, any particular report is, a few tenths here, a few tenths there, but the big picture is that inflation is much higher than we would have expected, let's say 6 months ago or 9 months ago, and certainly 12 months ago. And so we've been surprised to the upside. And if you look at the Atlanta Fed's inflation tracker, it's all turned red. So it doesn't really matter how you measure inflation. All the different measures are way above their norms.
President Bullard, you're like one of those contestants on Jeopardy who answers the question before the full answer is read. Because what I was going to say was that they didn't expect much improvement in January, and also that the market has already priced in a lot of Fed tightening out there, 100 basis points on the 2-year, and that really going faster or speeding up the rate hikes is not going to bring more tightening into the market or solve the inflation problem before the expectation that it comes down later this year. Is there already a lot of tightening in, and does going faster really make that much of a difference to how much you change the inflation trajectory?
Yeah, Steve, I mean, I love that argument. I have made that argument. I thought I was the one that made that argument. So the 2-year is up substantially since, let's say, last October when this process kind of got started. And that's great. That's helping us a lot. That means that there is some removal of accommodation already in the market. So that's great. But still, the Fed has to follow through and ratify those expectations that have been built into the 2-year. And if we don't, then it makes it appear that we're not defending our 2% inflation target, and that we're not trying to put to make sure that inflation is coming under control. I think the inflation that we're seeing is very bad for low and moderate income households. Real wages are declining. People are unhappy. Consumer confidence is declining. This is not a good situation. We have to reassure people that we're going to defend our inflation target, and we're going to get inflation back to 2%.
President Bullard, a very large investor I spoke with last week said the Fed put, the extent to which the Federal Reserve might step in to rescue the stock market, is either non-existent right now or way out of the money. Is it accurate to say that, given that the Fed is trying to tighten financial conditions, that it's less concerned right now with a decline in the stock market, or that it would take a more serious decline that prompt a reversal in policy?
Yeah, I mean, I've never been a believer in the Fed put, and you and I have talked about it in the past. The stock market and the Fed are both looking at the same thing, which is the future of the U.S. economy. And if the future doesn't look very good, both, the rates tend to go down, but the market tends to go down. And if the economy is looking good, then both tend to be higher. So I think people have interpreted that as a Fed put, but I wouldn't interpret it that way. And I also think that this year I'm still expecting 3.5% to 4% real GDP growth. And I think Omicron is fading here, so you're going to get a second sort of reopening of the U.S. economy. I think corporate earnings will be just fine. So I'm not really seeing any threat to the market at this point. So that's why I say that these initial rate hikes and balance sheet runoff are relatively cheap at this point from my point of view as a policymaker. We're not putting a restrictive policy in place. We're just removing some of the accommodation, and we're doing so in the face of a still very strong economy, a very strong labor market. It's already, as you just pointed out, it's already kind of priced into the 2-year, so everything's already been done here, so we just need to follow through and get going.
President Bullard, it's Becky.
Becky?
We speak to a lot of investors, and many of them in recent months have been pretty critical of the Fed, saying that they think the Fed is really behind things, behind the 8 ball, that they should have been doing some of these things sooner. I just wonder, given your hawkish commentary, if you think that's the case too. Is the Fed behind where it should be?
Well, I've been trying to push the committee, as you know, Becky, did we do this last summer? I think since last summer, I've been trying to move to a little faster pace of activity here at the Fed. I will say on behalf of the committee that we don't come out of a pandemic every day, and we didn't come out of the pandemic quite as cleanly as you might have thought, let's say, in the first 2 weeks of July of 2021, when deaths per day per million in the U.S. and Europe and the U.K., I believe, are all below 1. It looked like vaccines had done their job, and it looked like the pandemic was over. Since then, we've had 2 more waves. So I think that has complicated matters, and we've also had an extended discussion about how to handle the balance sheet and how to get reduction in how to taper the asset purchases. In retrospect, we probably could have moved that up faster and got that over with faster. But actually, the committee came to my position on this, and now we're going to finish in March. And even that maybe is looking like that wasn't fast enough now. But that just shows you how quickly the data are moving, how much is happening, and that we're in an environment where we can't just plod along sort of meeting by meeting and do a little bit here, a little bit there. We're going to have to react to data and be more nimble in this environment than we would have had to have been in the 10 years prior to the pandemic.
Hey, Jim, it's Andrew here. I'm in LA. I was here for the Super Bowl weekend and talked to a whole bunch of CEOs who actually seem to think that the supply chain may have actually is silently, if you will, getting better than people understand. And in fact, some were worried even that inventories may be building up in certain places. I was hearing this from folks in the shipping and logistics business, as well as the container business. And I just wonder whether you think that is going to play out in a way that actually may make things more complicated in the second half of the year.
Well, we'll certainly keep an eye on it. We certainly got a big inventory contribution in fourth quarter GDP. Most people have marked down first quarter GDP, the current quarter, because of Omicron. But I think you're going to get this reopening effect again in the second quarter and third quarter as Omicron fades. That would be my base case. I understand there's risks and everything. I would say the companies we talk to and the input I'm getting is a little more questioning whether a lot of these supply constraints will ease really all that much in 2022. The typical comment that you hear is that this is going to last all the way through 2022 and into 2023. So I'm not so sure. Maybe you're talking to different companies, and I certainly welcome the input on this. Also, I think companies are very innovative, and they're more than capable of thinking of ways to work around, substitute, change their product mix, do all kinds of different things to stay profitable.
President Bullard, just to maybe focus a little more on that, really specifically, how much of the inflation that we're currently seeing do you think is going to moderate more or less on its own? And how much do you think is going to be left for the Fed to target? It would seem something happened relatively recently to kind of kick up a sense of urgency of how fast the Fed needs to go. I thought it was just a couple of weeks ago you thought that a half-point rate hike in March didn't necessarily help out the Fed very much.
Yeah, I guess I've taken on board these inflation, the sequence of 4 inflation reports here, and become a little bit more worried that we're not moving fast enough. And I only shaded my position a little bit from 3 hikes before July 1st to 4 hikes before July 1st. So I still want the balance sheet runoff to get going in the second quarter. I see no reason why we can't finish the debate on that and get that program implemented. The balance sheet is up almost $5 trillion from where it was at the beginning of the pandemic. We don't need that anymore. We're still buying assets even at today. It is going to end very shortly here, but we need to allow the runoff to start to occur very soon here. That will take back some of the accommodation that we've provided. We've got a long ways to go if we actually want to be restrictive. And that's the concern, is that you'll get to the second half of 2022, quite a bit of inflation in the first half, which already looks like it's baked in. And then if you don't get moderation in the second half, we'll really be in a pickle if we don't position ourselves well in the next couple of months here.
President Bullard, one of the arguments that's made for those who want to take a steadier, even slower approach is geopolitical uncertainties. When you look at the situation of the possibility of war in Ukraine, does that give you pause for how fast the Federal Reserve should be increasing interest rates?
Well, geopolitical events like that are always very important events for the U.S., but we actually have seen fighting in Ukraine previously. So you could look to that example to see how much you think it's going to impact the U.S. economy. I'd say for Europe, it's probably more of a concern and more near-term concern, but we have seen fighting in this area of the world in the past. I do think it's quite an important foreign policy issue, but I'm not seeing it necessarily as a leading macroeconomic issue, at least at this point. I understand there's risks and there could be escalation and so on.
Sure. Jim, you've been a leader in talking about balance sheet reduction. I just want to tell you, our Fed survey sees $500 billion this year with an assumption that you begin sometime in the summer, and plus or minus $1 trillion next year. I want to know, can you tell me, is that in line with your thinking about the pace? And just to add on to that, you are in favor of using the balance sheet to steepen the curve, is that correct?
I'd like to get that effect if we can out of the balance sheet runoff. As you know, we're skewed somewhat to the short end, and people have been talking about that. The committee has not really come to any agreement on tactics here, and the chair has said that there'll be further discussions at upcoming meetings. So I think this is all in the works. I guess what I'm thinking right now, at least as sitting here today, is that I'd like to at least get passive runoff started in the second quarter, and I'd like to also have some plan B in our pocket where we could use asset sales if necessary to speed up the pace of runoff of the size of the balance sheet. Now, exactly how that would work is an open question, but it's that part that could put more upward pressure on the longer end of the yield curve than we would get from just passive runoff. But I'd be happy at this point to start with passive runoff.
Hey, Jim, you don't get to see the reaction in the markets while you're talking. I've been watching pretty closely here, and there was a lot of action in the markets earlier this morning just on concerns about what would happen with Russia and Ukraine. You had the Dow futures down by about 300 points, managed to stabilize on comments coming out from the Russian Foreign Minister Lavrov suggesting that diplomacy is still an option. We actually pushed into positive territory for the Dow and the other futures. Since you've been talking, the Dow futures have dropped again. We're now down by about 67 basis points, and I've been watching the 10-year yield, too. We went from 1.91% earlier this morning to 1.982% right now. So that's a pretty significant move, too. Last week, you caused a lot of reaction in the markets, too. Is that something you're paying attention to? Is it just a kind of an incidental issue where you're talking about your feelings with this? Do you look at the markets and think that there are some things out of whack, or think, the equities market has been too high, the yields for treasuries have been too low? How does that kind of play in hand? Because we get a lot of people trying to kind of guess that as they're listening to these things too.
Well, markets move a lot, and they are concerned about Fed policy. I've always tried to be a straight shooter on this and try to get the best policy we can for the country and for the economy. I think the path I'm mapping out is a good one, given the information that we have as of today. And maybe it does involve some repricing, but generally speaking, the U.S. valuation of the U.S. corporate sector and U.S. equities have been very strong through the pandemic. And I just made an argument a few minutes ago that I don't see any reason why that can't continue during 2022 here, even if the Fed decides to front load some of the removal of accommodation that we were previously considering.
Jim, is your thought that the Fed policy has to slow the economy down a trend, or are you still okay with above trend growth? And kind of one other add-on question. We have 11 million job openings. Wouldn't it be accurate to say that any Fed tightening would really just decrease job openings, not really decrease jobs in the economy?
Yeah, the job openings greatly exceed by millions the number of unemployed. So from that perspective, we have one of the strongest labor markets that we've ever seen, certainly since that data has been collected. We've got the unemployment rate at 4%, and we've got projections for rapid GDP growth in 2022. So I'm projecting that the unemployment rate may go below 3% this year. That would be one of the best in the post-war era. So we've really got the strong labor market here, and I think the focus has to be on the inflation side and not so much on the labor side. And I'm sorry, I got a little off on labor markets there. So direct me back to your question here.
Well, we have to go, Jim, but real quick, is wage inflation a reason why you think the Fed ought to move more quickly? Have you seen it already? Is it coming?
Everybody I talk to is scrambling for workers, and I expect to see that reflected in wages.
And in the inflation report as well?
Oh yeah, it will show up there as well.
Jim, thanks for joining us this morning. Jim Bullard.
All right, so that was a lot to take in. Obviously, the information is valuable, at least in the short term, because that's what's moving the markets. He still expects about 3 to 4% GDP growth, right, in 2022, and he expects about 4 rate hikes by July of this year. So that's going to be roughly about a 1% Fed funds rate by the middle of this year. For Fed's balance sheet runoff, he expects to start as quickly as possible, more so on the passive side, and not actively dump securities in the markets, because when they do that, it's going to drop the prices because there's going to be a lot of supply and increase the longer term yields, which is your 10 years, 20, 30 years, which obviously is not good for the market. So starting off with the passive runoff for balance sheet, and then if it's necessary, move on to active runoff for the balance sheet. But rate hikes, he is pretty adamant about 4 rate hikes by July, which is going to put us roughly about 1% for the Fed funds rate, which obviously is going to tighten the economy to some extent, but the labor market is strong, and he's also expecting corporate profits to be much stronger this year as well from all the guidance that we've received. There's also an inventory buildup that should play a role, when the time comes when we lap over some very, very high inflation numbers. So earlier this year, so let's just take a quick look on the actual inflation numbers here that I was going over. So recent, let me see if I can pull that up. Let's see, downloads. Let's just pull that up again on here. So we're just going to go over to CPI and Inflation Pdf. So you'll notice that right now, the back half of the year in 2021, obviously July, August, September, October, November, December was pretty high inflation numbers, right? 5%, 6%, 7%. Right now we're sitting at 7.5%. So right now we are in January of 2022, February 2022, right around these levels, where inflation at the same time last year was very, very low. So year over year, we're obviously seeing a big increase. But once we start to kind of lap over these numbers towards the back half of the year is when there's a lot of expectations for inflation to start, kind of stabilizing and start coming back down. That is the big expectation. And by June and July, we would also have interest rates much higher than where we have them right now. So tightening of the economy and a little bit of money supply starting to kind of slow down, and money velocity also slowing down as cost of borrowing goes up. The expectation again is for the second half of the year to start to really see some inflation curve back down. But again, thank you so much for joining, everybody. I really appreciate it, and hope we were able to kind of listen in on that for about 20 minutes or something. But let's just take a quick look on the yields. So we are just under 2%. Once again, we did actually breach over 2% just a few days ago. So we're now starting to curl back down. And this, again, is the spreads between the 30 and the 10. This is going to be the spread between the 10 and the 2. And this is the between the 10 and the 3 months. Obviously, the 30 and the 10 and the 10 and the 2 are obviously coming down pretty aggressively. So the last 3 times we've actually seen the spread go negative. We've seen a recession signal from the bond market, which obviously has resulted in an actual recession in the economy as well. This is from back in 2000, this from back in 1989, so this is back in 2005, 6, and this was back in 2019 when we also saw the spreads dramatically come down pretty aggressively. Volatility is higher, up over 8% right now, so pushing back over 29, almost 30 levels, and oil prices are getting tagged at this higher highs. So if you take a look at this, sort of like an uptrending channel where we are consistently making these higher highs and higher lows, like 8 weeks. This is coming in from December 20th, so 8 to 9 weeks of consistent gains for oil, pushing up 37, almost 40%, and we're now starting to kind of tag that resistance. It's going to be very interesting to see whether we start to kind of come back down or oil prices continue to rally higher, right? There's the expectation that oil is going to hit almost over $100 a barrel, $120 a barrel, and that is going to be very, very interesting to say the least as gas prices continue to push higher, fuel prices and whatnot. Bitcoin just up a little bit over 1%, back over 42,500. Ethereum's just over 2% in the green, just under $3,000 right now. So let's just do our quick poll for the markets. So I'll just ask you guys, markets today, and what does everybody think? Green, red, or flat? So all right, the poll goes out now, and make sure that you do vote. What is the resistance on AMD? Now let's just quickly go over some individual stocks as well. So AMD, it had a pretty big breakdown on Friday. It was down a little bit over 10%. So 118 is now going to be a resistance for the stock moving forward. We obviously did break down below 118. Right now trading at just about $114 a share. If it comes down under $100, more so under $90, I think is going to be very, very exciting opportunity for advanced micro devices, and I will once again be a buyer of advanced micro devices at those levels. But for now, just kind of staying steady, not really doing much. We did analyze AMD over the weekend. I did like a specific video on advanced micro devices, going over the valuations, going over a price target as well, and then also going over the comparison between Intel, Nvidia, and AMD. So I think AMD, for the growth that it has, I think it trades at a very reasonable valuation. So under $90 is going to be the level where I would personally be watching very closely. But for now, $118 is going to be that resistance. Steve says, Caddy, add from green to red, from green to green, and green all day, red all day. That's a great option that we can add, definitely. So I like that. That's like more of an accurate prediction, other than just like assuming red or green. So maybe we'll start doing that from tomorrow. So thank you. I think that's a great suggestion. So let's see where we are for the QQQs. We are pretty much flat here. So no change right now. We're only down about 7 basis points. Markets obviously have seen a big jump here. This is, obviously after comments from Jane Bullard and of course coming in from Ukraine and how the negotiations have basically started again. And this right here is a SPY, big jump from 436, jumped over 1% and right now pretty much in the green, up over 5 basis points, and Dow Jones is pretty much flat here on the day. Apple is down about 40 basis points, Amazon down about 0.5%, Facebook up over 20, and we got PayPal slightly down about 43 basis points as well. All right, so market can go up or down or maybe sideways. Yep, so those are all the options pretty much. You covered it. So you covered all the bases there. All right. So if you have any questions about any stocks, I'm happy to go over those. But other than that, I didn't get a chance to actually put together like the upgrades and downgrades list, but this is the earnings calendar, which I posted in our Discord. So tomorrow we've got Roblox, Upstart, and Airbnb reporting. And then Wednesday, we've got Shopify, which by the way, I did a video on Shopify earlier today. So you guys are more than welcome to watch that. And then Crocs and Trade Desk. Trade Desk, I'll try to do a video for Trade Desk before the earnings. But Nvidia, I've also done a video on Nvidia as well. So make sure that you watch that if you have the time. And then Palantir reports Thursday pre-market with Roku, Walmart, Fiverr, and then Dropbox also reports on Thursday after the bell, and DraftKings and John Deere reports before the open on Friday. And then of course Matterport, QuantumScape, you got DoorDash and Fastly also reporting on Wednesday after the bell. All right, so let's take a quick look on some of the companies here. So let's go over Tesla very quickly. So Tesla is slightly flat here, so pretty much flat here, $859.98. $900 is going to be that resistance right now for Tesla. Support level is going to stay put at close to 788. That's the level that we're watching for now. And of course, if it continues to pull back, a lot of stocks, that's the thing. Right now, I think it's a great opportunity for us to make a list of stocks that you believe in for the long term, right? Fundamentals and the business that you believe in for the long term, and identify those price levels, right? It's really important to have a buy list, have a wish list for stocks, and if they continue to pull back, focus on the quantities, right? Just keep accumulating, in my opinion, for the long term, because business fundamentals will win out over the long term. Macro, yes, it's very exciting to predict what's going to happen, with interest rates, with inflation, with Fed's policy and whatnot. But over the long term, I think the fundamentals and the businesses are going to be what's going to be driving the markets in the future. So if you believe in Tesla for the long term, it doesn't matter where interest rates are going to be a year from now or 5 years from now or 10 years from now, right? If the company is going to be growing, it's going to be growing regardless. So support level right now, 788, resistance at close to $900 right now. So Moises, are you long on Facebook? I am long on Facebook. I am down close to, I think, 20%, 25%, but I am still long on Facebook. I have plans of actually dollar cost averaging even more. Victor, why is InMode down after good results? So I think it has a lot to do with guidance, and we discussed it when InMode actually reported numbers. And overall, I think it trades at a fair valuation. And the reason why it was down because of the guidance. They only guided for a 17% increase in revenue. That's completely fine because they have been known to guide lower and then increase their guidance as the time goes on, as they have more visibility into the year, into 2022, and as they work with their customers and whatnot, they do kind of raise their guidance. But now, obviously it was down over 8% on Friday. A lot of stocks were, but after the earnings, it basically was down over 4%. Got bought up intraday, but still pulled back on the day. So DraftKings, yes, I'll see if I can do a video on DraftKings as well. Ahead of the earnings, but I was actually doing some analysis on Facebook today, so let me see if I can bring that up. And I was just going over like the worst case scenario for Meta, right? So I was going over the worst case scenarios for Facebook. Let me see if I can open it. So let me see if this is in fact the spreadsheet here, or maybe it's not. Nope, it's not this one. Here, let me see if I can open it very quickly. So it's going to be Facebook right here. Okay. So what I did here is basically just taking into account, I've already put in all the numbers, right? So revenue, gross profit, margins, operating income. This is for 2021. This is what they actually did. 38% growth in revenue year over year. And EPS actually grew by 37%. So 36% right here. And what I did over here is so forward, this is the valuation for Facebook right now. So based on 2021 numbers, the market cap, it's just under 600 billion. We're trading at a PE of 15, 5 times sales, price of free cash flow 16, enterprise value to EBITDA 10. and price to cash at 12. And this is the forward numbers, right? Forward, we're even lower at 14 PE, might even be 13. So 13.8. And price to free cash for 14, price to sales at 5, enterprise value EBIT at 9. And what this does is that takes into account Facebook's EBITDA growth and assigns an EBITDA multiple. So again, everyone who's part of the channel, you guys probably already know the valuation multiples that we use. So enterprise value to EBITDA here, price to sales multiple over here, and then earnings multiple over here, right? So I want to ask you guys, what do you think revenue growth wise? Where do you think Facebook's headed for the next 5 years? Till 2026, where do you think revenues are going to be? So what I have right now is 10% growth. This is me being the most pessimistic and most bearish case on Facebook, right? At 10% growth, and that's going to be $157 billion in revenue, giving it a 4 times multiple, $630 billion market cap, and that represents about a $220 price target. That's literally where we are trading right now if you think that Facebook's going to grow at about 6% for the next 5 years at 4 times multiple. And Facebook is right there, right at price target at $220. But obviously, this is the most conservative you can be with the price target. I don't think that they're going to grow by 6%, every single year for the next 5 years or so. I think that's going to be much higher. But that's where we get to debate, right? That's where we kind of go back and forth and try to understand what the growth looks like. And this is the same thing with income, same thing with EBITDA as well. So. If you make those numbers sort of play out and the price target comes to at about $276 right now, 5 years out, and obviously given where the price is today for Facebook, let's see. So we are sitting at roughly over $219. That's about a 26% upside, right? 26% upside given how conservative or low these multiples are. Like enterprise value even at 14, like that's an incredibly cheap multiple. Even long-term P multiple are trading at 14 times, right? 14 times PE. So that just goes to show that this is the most conservative I've ever been on a stock. And even then it's got a 37% upside, 26% upside. And of course, if they actually do end up giving us a higher growth and higher guidance, then these prices obviously will be readjusted to a much higher number. All right, anyway, so let's see. Nvidia way overvalued. I wouldn't buy unless under $160. Yeah, so Nvidia is definitely, by all means trading at significant valuations. We talked about it, during over the weekend as well. So I'm very interested in Nvidia. I think it's got a very, very strong growth company, right? Very nice, consistent revenue growth, earnings growth, EBITDA growth, and whatnot. But the valuation is what's keeping me away from the company right now. In the short term, valuations can really take a beating and they can compress. But over the long term, if the fundamentals are right, if you're paying the right price, it can really pay off. So that's where I would personally be looking at close to $200 right now. All right, let's see. So Jazz, is it because you're selling a course you talk about buying stocks in this current market heading into a crash? I don't know what you like. Could you just elaborate a little bit, or do you think are we heading into a crash? Or I don't understand your question. If you could be a little bit more clearer, I'm happy to kind of answer that for you. All right, let's take a look at HIMAX, HIMAX. So HIMAX. Let's see where it's trading at right now. So, wow, I think we have covered this stock. So for the most part, just consolidating sideways. Resistance stays put at close to $17 and support at the moment right now at just about $9.80. Market cap is just under $2 billion with a nice dividend yield as well. So Jazz says, I think we have more downside going forward. Prices will be lower. That's fair. I think that's a very plausible outcome, right? It is possible definitely in the markets, given the macro factors, given the fear and the uncertainty in the markets. But as we have talked about over the weekend as well, and as we have already mentioned it before, that macro factors do affect the markets short term. However, this is not specific to companies, right? If you look at the fundamentals in the business of any company that you're investing in, you hold quality companies for the long term and it will pay off over the long term. That's all I'm concerned about when it comes to just investing, right? I'm looking for companies, I'm looking for deals, and I'm looking to pay much lower prices for the value that I'm getting. Plain and simple, right? I'm not going to get into, where interest rates are going to be or start speculating on what GDP is going to look like this year or what inflation is going to be 2 years or 5 years from now, because that nobody can predict that. Nobody knows for sure where those numbers are going to be. For PE right now, for HIMAX, sitting at just over 6, so definitely very, very low valuation. Price to sales just over 1, price to cash flow just over 7, and enterprise value to EBITDA at over 4. So lots of consolidation right now. As I've mentioned, very, very stable revenues for the company, coming in from 804 million to just over 889 million. Quarter over quarter has seen a nice growth. So I think this is on my watch list for me to do some more analysis on. So I will be looking into this company in a little bit more detail, but for now, this is a very, very consolidated pattern with a support at $9.80, close to $10, resistance close to $17 a share. All right, so zoom out, look at the markets. It went vertical for the last 2 years, makes no sense. So let's take a look at the S&P here. So yeah, I mean, if you look at the 2 years since 2019, 2020, they have definitely gone up, but at the same time, profits have also gone up, revenues have also gone up, since. And that's what drives the markets long term. I think there's a big misconception that macroeconomics is what drives the markets long term, or this geopolitical tensions or inflation or interest rates or GDP or all those things that actually move the market. It's profits, it's companies' revenue. The moment a lot of the companies stop growing, a moment a lot of the companies stop producing profits, and there's problems with actual revenue and earnings, is when the markets are in trouble, like fundamentally. But if they keep posting very, very strong growth rates, if they continue to kind of post very strong earnings and revenue and EBITDA and margins and whatnot, that's what's really going to be driving the markets over the long term. Yeah, the monthly chart is definitely for sure a lot more scarier. Absolutely. So yeah, I mean, if you take a look at the markets like that, obviously it's been very, very scary. But this can be said at any time during the history. Like if you look at any time in history of the charts here, you can make an argument that the markets are scary. The markets are scary over here at 329. This is back in 1987, right? You go back even further. Let's just go over here. The markets are scary at $92, guys. S&P 500 is so scary back in 1965 at 92, right? So I think this can be said throughout history if you go back. But we all know as profits and revenues and market share and total addressable markets continue to kind of grow, that's what's really driving the markets over the long term. All right, so 13,000 for the NASDAQ. Yep, that's the level that we're going to be watching. I think that's the next technical support to keep in mind for the markets. And looking at our poll today, so we got about 53% people voting for red, 33% voting for green, and 13% saying that it's going to be flat today. So Jeff, I think that's a good suggestion here. Square versus PayPal, and then I'm going to add probably one more company. So just give me one more company. Again, we started a new playlist on YouTube called Pick One. And it's just like a fun way to kind of do stock comparisons and take a look at a handful of companies within the same industry. And I basically go over the fundamentals and the valuations and comparables for them, and then kind of pick one stock that I would personally like to hold. But again, this doesn't necessarily mean that other comps are bad or other stocks are not worth investing in. It's just that if I have to pick one, I would pick that particular one. But it's just a nice way for us to do some stock comparisons. So yeah, so I think Square, Upstart, PayPal, and SoFi could be a nice list. I agree. I think that's a good suggestion for doing that video. But anyway, so, all right, the polls are done. Most people think the markets are going to be either red or flat. Very few people, about a third people, expect the markets are going to be green today. So we'll see what happens. But the NASDAQ still down about 14 basis points. We got the SPY down 4. Dow Jones is down a little bit over 7 basis points, with Apple now starting to pull back once again, down close to 1%. PayPal down 1.7%. And we got Facebook pretty much flat here, with Amazon down close to 1% as well. All right, so let's see if you have any stocks you want me to go over. Happy to do that for you guys. We'll keep a close eye on the yields. We'll keep a close eye on the volatility. Still up over 7% here. VXN will open here in a few minutes, and then oil prices obviously starting to curb back down. just under $94 a barrel. We got about 3 minutes left for the markets to open. Look at that, Ethereum finding support here perfectly. So it came all the way down, validated that 2820, 2800 levels, and now we're starting to see that first green candle once again after 4 consecutive days of selling here. So Ethereum starting to kind of bounce off of that support once again, and Bitcoin, where is Bitcoin here? It's up a little bit over 1.5%, so starting to see that push higher once again. So resistance we have to break out of is going to be this right here, close to 45,000, 45,600 for Bitcoin. Tim, what do you think about Upstart ahead of earnings? So I actually did a video on Upstart recently, so you're more than welcome to watch that video. I went over everything, earnings, what they're expected to announce, the revenue, historical revenues, shares outstanding, all that stuff I covered in that video. But overall, I don't expect Upstart to report like a miss or anything. I expect them to report very, very strong numbers, strong growth year over year, revenue and earnings also. The future guidance is what's really going to drive the price, but Upstart also trades at a little bit of a rich valuation. So if it comes down, under 90, under $80 again, closer to 75, I think would be ideal. Would love to kind of pick up some more shares for the company right now, but it kind of feels like it's been forming a bear flag as well. So we'll see what happens. Brian, what did Bullard say? So there are my notes. If you scroll all the way up in the chat, I was posting as he was speaking, so you can kind of take a look at the notes that we have on what he said. But overall, he's expecting about 4 hikes by July, or 1% federal funds rate by the middle of this year, and then a passive balance sheet runoff that could occur very, very soon. And he's also expecting about a 3 to 4% GDP growth in 2022, with corporate profits staying strong for this year. All right, so let's see. Okay, so less than a minute left for the markets to open. We're going to switch over to our actual indices here, and we'll see what the markets have in store for us today. After the last couple of days of brutality in the markets. So S&P, remember, the level that we're really watching from a technical standpoint is this 4250. This is something that I've drawn. Kind of feels like head and shoulders. We'll see if that actually plays out or not, but 4250 is going to be that support, that next technical level from January 24th and from October of 21 and from July of 2021 as well. And the NASDAQ is going to be 13,000. 13,000 is the most important level, technical level to watch. This is where the bulls need to hold the line right here. And we're still in a proper correction for the markets, down about 14, almost 15% from all-time highs. All right, here we go. And earnings-wise, there's not a lot of earnings coming out today, but there should be starting off tomorrow. And then, of course, later this week, we got companies like Shopify, Nvidia, Palantir. Palantir should be interesting because that's one of the stocks that's been selling off quite a bit. All right, off we go. We'll keep a close eye on some of the companies here. So Facebook, Amazon, PayPal, and Apple. And then we'll switch over to some of the other ones here shortly. The 10-year yields are still just over 1.986. AMD close to 2% in the green, so back over $115. We got SoFi pushing up 1%. By the way, that halftime show, that was pretty cool, huh? With at the Super Bowl, I think that was a lot of fun. And the game itself, I think the game was amazing too for everyone who watched it. I know that I was live streaming during that time, but hopefully you guys were able to watch that as well. And I think it was fun. So, does earnings matter? AMD shoot up after earnings and now back to pre-earnings. Earnings do matter. In fact, earnings is what matters most in the markets. Yeah, nostalgia of 50 Cent and Eminem, definitely. I didn't check out the Coinbase ad. I've been hearing about it. People have been sending me. I definitely need to look at the Coinbase ad, and I think they spent like what, $10 million on that ad for like on Super Bowl. But yeah, I definitely got to watch that. And yeah, Snoop Dogg too. 90s kids going crazy at halftime. Yeah, I agree. So for AMD, yeah, like I said, earnings do matter. Earnings matters most. And this has obviously been very, very fear-driven in the markets, and that's what happens, right? When there's some external factors moving the markets, like macroeconomics or anything like that, nothing matters. Fundamentals and technicals, fundamentals and technicals tend to not matter in that time. Support levels get broken, regardless of how well the company earnings were, stocks still drop, and that happens, in times of uncertainty, in times of when the volatility is higher, because at that time people just want to kind of get rid of that stock and get out, right? So PayPal going to 113. Yep. So right now it's just at about $113.80. Facebook is just at 218. Amazon 3,046, and Apple just under 168 right now. Tesla is down about 0.5%, just over $855. Let's start with red here. So Fubo down close to 3%. Astrospace is down under 4.5%. Then we got Moderna down over 3%. Neo close to 2%. Shopify close to 2%. Lemonade down under $29. PayPal just 113. Might go under $113 today. Pre-market we were as low as $112.50. Then we got Take-Two Interactive down about 60 basis points. What is green? So Mars is down about 70 basis points. And stocks that are green right now is only AMD pushing up for the most part. Roblox is up close to 80 basis points. Coinbase is up close to 1%, Snapchat 0.5%. So yeah, more or less it's like mostly flat markets. Nasdaq obviously now starting to pull back here with the S&P and the Dow Jones also dropping. Apple's got a support, I believe, in the 168s. No, so actually it has broken its support. Now it's acting as a resistance for the company, unfortunately, because we are now trading below 168. So this right here is going to be a resistance to watch for Apple at the moment. PayPal, I wouldn't even worry about talking about resistance right now for PayPal because resistance levels are just, too up there. For now, we just have to take a look at the support. Where does it actually validate some support levels, right? And there is some historical support. Like we had this curve all the way over here back in September, August of 2019 that we were just kind of validating, pushed higher, and then the pandemic crash, which is at roughly $100, which, given where PayPal and how much weakness there has been, it's possible, right? Wouldn't be surprised if it actually see that for PayPal. Let's take a look at Tesla. So Tesla's got a support at around 785, close to 775 levels. So, if you come back on the chart here, so we had a support back in January 29th, 2021. And then once we broke it down, we went back up to retest that old support as a resistance. So I'll pay close attention to $780, $775, roughly around those levels. And then we also bounced off of that level here. So that is, the most important level to watch right now. So PayPal's low was $113, right on the dot. Somebody called it. So Locator said PayPal going to $113. It was literally on the dot at $113 and then got bought up. So good call there. So yeah, we'll see if the markets kind of stabilize a little bit. For this week, from a macroeconomic standpoint, what do we have? So let's take a quick look. So we have the actual PPI numbers. So producer price index comes out tomorrow, right? That's going to be another inflation report. That is probably going to be very important for the markets, at least for tomorrow, because that tells us, how much businesses and, actual producers are paying for raw materials and goods and services. And the expectation is for us to see about a 9% increase year over year and about a 7.8% increase when you exclude for food and energy. And then, of course, retail sales come out later this week on Wednesday, February 16th. So retail sales and core retail sales. And then finally, consumer confidence and GDP reports and the personal consumption expenditure later this month. This is another meeting that starts at 11:30 a.m. Today. By the way, happy Valentine's Day, everyone. So hope you guys had a great weekend. But today we've got the board meeting from FOMC members. And again, this is happening on an expedited measures, but this has happened every month, right? So this is not something that is like an emergency meeting. I know it was very, very uncertain for a lot of people that the Fed's meeting in a very expedited procedure. Maybe they are going to raise rates earlier, but this has happened, pretty much every month. This was from last month, from January of 25th and 26th. And then we've also had meetings, back in December, November, 2021, October, multiple times in October, like 8th, 20th, 25th, right? And this is back in 2017. So it's not like a emergency meeting or anything. It's just like regular standard procedure for the Fed to do these meetings. All right. Yes, so Zim, Lokesh, I have plans of actually doing a proper analysis on that very soon. Again, I've been trying to get as many videos out as possible. So most of the FANG stocks are done. I have to do like an updated analysis on Microsoft. And then I have to get through all the list for this year, for 2022, to kind of do fundamental analysis on them. Ernesto, Kelly, what do you think? Markets will be red or green? It's hard for me to predict exactly. I mean, my guess is just as good as your guess. But I'm really looking for specific stocks, right? If they hit my buy target, that's where I'm really looking forward to. From a broader perspective, from a market perspective, honestly, it doesn't really matter to me if the markets are green or red. Well, I would prefer for the stocks to be down, and that give us an opportunity to kind of dollar cost average and buy more. But really looking forward to like specific stocks like AMD, looking for Facebook, looking for PayPal, looking for Nvidia, looking for companies like Shopify as well. And then some other value plays, right? JP Morgan, Walgreens, Costco, some of the stocks that I'm just like watching, and even Vertex Pharmaceutical has done really well in 2022. I mean, this stock is up over 6%, right, in this year alone. And if it weren't for this pullback from 255, it'd be up over 14% this year. So we've been trimming a little bit of Vertex. So really just watching individual stocks and not so much like the entire market. So Upstart, watching very closely, if it comes down to under $80, $75, then definitely would be very interested in accumulating more and dollar cost averaging more. So yeah, Microsoft, I will be doing an analysis on that very soon. So what stocks are you trying to snipe right now? So right now, I mean, based on the valuations, there's only two, like Facebook and PayPal are really the two stocks that I'm really interested in after this pullback. But I just have to keep that allocation to a minimum, and obviously don't overexpose myself to this one or a few positions. Other than that, really just keeping a close eye on Nvidia. This is a stock that I've never really owned, but would love to get it at a lower price point. Advanced Micro Devices, watching closely if it comes down to a better value, under 99, under $80 a share. Would love to kind of buy that as well. So Oscar, how do you balance dollar cost average on a stock as it starts to become a large percentage of a portfolio? So there's a couple of ways. The first way obviously is that I focus more on the other parts of the portfolio. So for example, Facebook right now is about 8.5% of the portfolio, so definitely stings. That's one of the stocks that have really kind of hurt me the most this year. Maybe I'll do like a video on that very soon. But if that becomes to a level where I don't want to overexpose, then I will start to focus on other holdings and kind of bump those numbers higher, right? Bump those, like whether it's Vertex, whether it's AMD, whether it's TrueLeave, whether it's Take-Two Interactive. Some of those companies, I will start to kind of buy those and dollar cost average those, given the valuation is right, so that my Facebook's allocation starts to kind of come down. So diversifying away from some of your larger positions is one way to kind of reduce your allocation in some of those companies. I think that's the best way to do it. And then of course, the second way is if you can just trim some of that position in itself, right? So for Facebook, if you think that that's too much of a concentration or big of a position, then you can kind of trim some of the stocks, some of the shares there. Arnold says, how do you feel about 85% concentration in Tesla portfolio? It really depends. I mean, everyone's got a different strategy, right? So if you believe in Tesla long term, right, and if your conviction's really high, if you believe Tesla's going to be worth a lot more 10 years from now, 15 years from now, you don't care about the macroeconomics today in the short term, and you've done the research, then it completely makes sense. I was going over one of the things from the Berkshire Hathaway meeting, and believe it or not, Warren Buffett and Charlie Munger collectively in their investing careers of over 60 years, they've invested in over 500 companies. 500 companies, okay? That's how many companies they've invested in. But Charlie Munger said this himself. Over our investing career, we've invested in 500 plus companies, but if you take away the top 10 companies that have performed the best, like Apple's and Coca-Cola's, if you take those top 10 companies away, Berkshire Hathaway's track record is pretty average. It is very, very average. The only way they were able to outperform the S&P is just that top 10 companies that moved the needle for them in terms of generating alpha. So it really, you don't have to be right on every single stock that you pick, right? You don't have, if you have a portfolio of 30 stocks, you don't have to be right on 30. And to be honest, you can't be right on 30 stocks, right? It's almost impossible to track 30 businesses and know them by heart. You have to be right on 10, maybe 12 of them, and just be and bet big, and obviously be able to generate more, and then that's going to pay for the losses and more over the long term. That's really how it comes down to be, right? So obviously I'm not here to tell you what to do with your money, but 85% concentration in Tesla, good luck. Definitely good luck with that. All right, so Coinbase is shooting high, so let's take a look. So Coinbase, yep, so just under 2% here in the green. As a result, Bitcoin obviously is pushing higher, and Marathon is slightly down, close to 19 basis points. We got the NASDAQ now finally turning green here. S&P is flat, and the Dow Jones still down 20 basis points here. And this is going to be the Dow 30. Amgen down. We got Chevron, Exxon pulling back here finally after like an insane run up in 2022. So as oil prices are coming down, these two oil giants are starting to pull back a little bit. Walgreens down over 1%. Qualcomm, actually I have plans of doing a fundamental analysis of Qualcomm soon. I will be going over like the revenue, the earnings, and everything for that company soon here. Sir, what are your favorite Cathie Wood stocks for the long-term growth stocks? So believe it or not, I did had to bite the bullet, and I picked up ARKK on Friday. And the reason, again, very, very small position, like, less than 0.5%. And only reason is because if you look at some of the companies here that are in the ARK's portfolio, right? And I can go ahead and invest in them individually, but I think if I can get like one single ETF that has all of them, that have the growth sort of feature, like growth, sort of higher growth in them for the revenue, and they've de-risked so much, meaning that they've fallen, some of them down 70, 80%, like 85%. So they've essentially de-risked so much, right? So they're not, in my opinion, they're not in like a bubble or anything, right? They're definitely trading at very low valuations. Take Zoom, for example. Take Tesla on a forward basis, right? Take Coinbase, take Teladoc. A lot of these companies are now trading at reasonable to fair to moderate valuations. They're still high from traditional numbers, but they've definitely come down so much, and they've de-risked to a point where I had to at least take a stab at this. And obviously the lower it gets, the better the valuation, the better the pricing, the better the risk reward becomes for these companies. And that's one of the things that, strangely enough, we have to kind of rewire ourselves and remind ourselves that as prices come down, risk comes down with it, right? It doesn't go higher. When prices come down, risk doesn't go up, it comes down. The stocks become less and less risky as prices come down. All right, so just one more stock here that we're going to analyze here very quickly, and let's take a look at Affirm. How is Affirm doing right now? So Affirm obviously had a big breakdown. It's probably like an intern or someone who actually messed up on their tweet on reporting the actual numbers. So ARKK Sunshine, the support is going to be roughly at about $65. That's the level that it kind of bounced off of. But Affirm definitely is now hitting a new 52-week low at $44.80. So we'll keep a close eye at a resistance at roughly here at close to $70. And I did a recent video on Affirm, so make sure that you do check that out as well. But resistance right now at close to 47, all the way up to $70 right now for the time being. So Rami, if your average price is Facebook is 300 USD, would you DC it now? So there's a couple things that really are going to be key to making your decision. Number one, what is your conviction on Facebook, right? Do you believe in the company long term, right? Do you believe in the next 5 years, 7 years, 10 years in Meta? And is that your time horizon, right? Are you looking to trade? Are you looking to invest in it long term? And where your conviction is for the company 5 years, 7 years, 10 years from now. That's number one. Number two, what is your percentage allocation right now? Is it to a point where it needs to be upped a little bit? Like meaning that you had a target of, let's say I want to put 6% in Facebook and right now it's at 4%. So are you buying to kind of increase that allocation, or is it already to a point where it's like overexposed to Facebook? You're just doing it because you want a dollar cost average down, right? So those are some questions that I would ask myself. If you believe in the company long term, if you believe in Meta for 5 years, 7 years, and your allocations, you're not too overexposed to this company, then the valuation is definitely very, very cheap. I did pick up Meta last week, I think at close to 220 levels, 225. So in my opinion, I think the valuation is incredibly cheap right now for the stock. And even on my bearish analysis in the most pessimistic view on the company, it's still expected to at least bounce up to $275, $280. And then of course, everything on top of that is going to be icing on cake for the company. So man, I want to put my money in the market, but I'm scared. I haven't done anything since early January. And oftentimes, I've mentioned this before to our Discord as well, oftentimes doing nothing is also a decision. And that's completely okay. The last thing you want to do is make a decision that you're not comfortable making, right? Because everyone, like we all got to sleep at night, right? So if you're not able to, if you are for any reason scared, or if you think the markets are going to go down further, that's okay, right? At the end of the day, you need to be comfortable with what you're buying, right? So if you think you want to wait a little bit longer, that's okay. If you want to buy in smaller quantities and then dollar cost average in, that's completely fine too, right? In fact, I even suggest people that buy one share, right? Buy one share and then slowly and steadily dollar cost average in as you build your confidence in that particular stock or in that particular sector or in the markets in general. So you don't have to like jump in all at once, right? Pace yourself slowly and steadily and kind of build your confidence in the markets. So I think that's very, very important. Over the long term, if you're buying quality companies, as Peter Lynch has always said, if you buy quality companies, if you just do some simple research and understand the balance sheet, understand the revenue growth and what the company is doing, over the long term, you don't have to pay exuberant fees to advisors, to managers. Everyone is happy to do that themselves. All right, guys. Anyway, I got to run, but thank you so much for checking in. And the market's now starting to push a little bit higher, 32 basis points in the green here. S&P is pretty much flat. Dow Jones is still down close to 0.5%. But again, thank you so much for joining in. Remember the earnings calendar and the economic calendar as well. Lots of things coming up here, and the yields are just under 2%. But thank you so much for joining. I really, really appreciate you guys. Make sure that you do check out the Patreon link down in the description below if you want to join our private Discord, our money investing community, and of course, get access to all the buy and sell alerts. And hope you guys have a great, great week and a great green day today. And once again, happy Valentine's Day. So wish you all the best, and I'll see you guys in the next live stream.